Now, just before we conclude, there was one interesting session and the new development which we were observing related to the infrastructure sector. I know the serious players are already practicing that also. And it is about the emergence of surety bonds from global scenario to India. And we have a sort of a specialist on the subject who was here, Vikas Khandelwal. He is a chartered accountant, an insurance expert, but has been working on setting up a monoline insurance company exclusively on sureties. So I'd like to hand over things to Vishnu.
Thanks, Sandeep. And yes, surety is of course very close to my heart. I started working on surety as a concept almost about 8-9 years back, and that was a time when most of the people hadn't even heard of surety bonds as a concept, except the EPC players. So the way I got introduced to sureties was I was part of an insurance broking business, and most of our clients were from the EPC sector. And the overwhelming requirement was, IAR, CAR, and everything is all good, but can we have some surety bonds? And that was my first introduction to surety bonds. Post that, the subject became so beckoning. It almost became, it kind of compelled me to use this to take it as a career option. So that's when this thing. Now, surety as a product predates even insurance. It's even older than insurance. And one of the first known instance, or let's say even documented, I don't know if there is a document to this or not, but first known instance of surety bond was during the times when there was trade between India and Greece, and most of the goods used to go either by land or by shipping routes. There was this lady who was married to a Greek trader, and she was the daughter of a tribal lord in India, and this tribal lord had entrusted one of the caravans, the head of the caravan, which was traveling from India to Greece with all the goods, for the safe transit of his daughter. And that was the first known instance of using surety as an assurance of performance that we know of. Yeah, it's actually very old. Over a period of time, surety as a concept has evolved, and now it's almost become ubiquitous. So you see all forms of assurance, all forms of guarantees, etc., all across the place. So whether it be, let's say people taking a loan, you do have, the promoters guaranteeing the loan obligations of the borrower. You have use of sureties in courts. So you have a bail, the person who extends a surety on behalf of a person seeking a bail, or for that matter, even courts accept bank guarantees. And more for the context of our gathering here, I think government procurement and government constructions are full of surety bonds, and which essentially is, I think, today in today's context, when India is driving towards, or when India looks at a very ambitious plan of building world-class infrastructure across various parts of the country, that becomes a stumbling block in India. So my presentation is extremely short. The idea, because of the nascency of the product, the idea is to simplify it to whatever extent possible. Happy to take any questions at any time during this entire thing. Please feel free to ask questions. Let's not wait till the end. I'll be happy to answer. See, we've already understood the kind of infrastructure projects that's there, so there's no point of me going back and repeating things in terms of whatever we are looking at building. But the real pain point today is we are almost locking in about $1.28 trillion worth of collaterals and margin money. See, what happens is when a contractor or an EPC contractor wants, and I'm talking most of the mid-level or even I'm talking mid to larger levels, I'm not talking about the L&Ts, etc. When they go in for a bank guarantee, for everything that they want to build, they've got to put up bank guarantees towards bid bonds, performance guarantee, advance payments, retention guarantees, and maintenance guarantees. So, and bank guarantees cater to almost about 95-97% of such requirements, right? When they go for bank guarantees, they're required to put up collateral. They're also required to put up margin money. And then over and above all that, they're also required to pay fees. I'd like to narrate in small incidents. I was meeting with the PWD empaneled contractors in Meghalaya. And at that point of time, Meghalaya was looking at adopting surety bonds for their infrastructure development in the sports infrastructure as well as tourism infrastructure development. So when we met with the contractors out there, and I'm talking about mid-level contractors in Meghalaya, they had to put up 150% collateral in terms of land, property, or buildings, even national savings certificates or fixed deposits. Over and above that, anything between 15 to 35% cash as margin money, and then pay fees to the extent of 2.5 to 3.5% fees. Now that's the extent of malaise which kind of inflicts to this entire sector. And that locks in that $1.28 trillion worth of collateral. So what does it do? It impacts, net, it impacts the contractor's ability to deliver. See, as it is, he's cash strapped. And then you ask him to put up all these kind of collaterals. And then you expect him to deliver on time, right? So it impacts his liquidity that's available with him. This high margin and the entire collateral that he's put up, he could otherwise use it for raising cash-based loans, and which would eventually go into the for the execution of the projects. Another incident that I'd like to narrate was, see, I've actually worked across multiple state governments, and that's where all these incidents come. So we've actually reached out to almost about 8 to 10 state governments, and I've worked very closely engaging with them on the need for guarantees and reasons for invocations, etc. So I was with, we were presenting this concept to the Madhya Pradesh Rural Roads Development Authority. And one of the problems that they were facing was lack of participation. So this managing director of this authority, and he would say like, look, Vikash, we keep coming out with bids, but I don't get the participation. There's nobody who comes in and even puts in a bid. And the main problem was most of these guys actually didn't have collaterals to go and put up at the bank. And we are not talking about extremely small, incapable contractors. I'm talking about contractors who had a good track record of delivering projects. These were the people, and they would just not participate because they didn't have the collateral to submit for a bank guarantee. Another incident was at Satna, where the lady who she called up the contractor right in front of me, and she said that, look, why don't you come and collect your advance payment check? And this guy said, like, I need to arrange a bank guarantee before I can come and collect your check. So let it wait for some time. Let this get delayed, but I don't have the collateral to do that. The reason for me to narrate these incidents, I mean, these are real life incidents, and I'm sure a lot of you coming from this sector would also have encountered or come across such kind of incidents, is only to emphasize on the extent of pain that is inflicted on this entire sector. So reduced participation. Now, we've been using bank guarantees for a long time for project assurances, so that people come in and they put up these kind of assurances so that the project owner is comfortable that this thing. But this is a system, I believe, has failed the entire sector. And when I talk about the entire sector, I'm talking about not just the contracting community, but it's also failed the project owner, or the person who's actually awarding these contracts. Right? A is, see, when a bank approaches a certain risk, and most of the decisions are based on collateralization. So when you look at, I think a large part of it is, okay, your financials are there, but your projections are there. Can we look at what is the kind of collaterals that you do? And a lot of that decision to extend credit or not is just dependent on the collateral. But they don't look at anything which is related to, let's say, performance. What's the kind of manpower that these people have? Do they even have the capability to execute a project? We've come across instances where a person who's predominantly worked in a particular sector would just go across and bid for something else, and he would get the contract, and he would get a bank guarantee just because he's got that. But there's no specialization. But when you look at backing such kind of people with your guarantees, you are actually looking at a higher probability of default, because collateralization will not prevent any contract from going, let's say, getting delayed or a cost overrun. And again, coming back to the extent of the problem that we have in India, one glimpse at the Ministry of Statistics and Program Implementation site, you'd come across the instances of delays and cost overruns, right? Because there are some projects which are delayed even by 20 years, and this is primarily, you see them in rural electrification, rural roads. I mean, projects can keep going on for ever and ever. So that's the that's the problem that we have. Sorry. Now, how does this work? Number one is, see, if you look at it purely from a contractual perspective, we've had one session earlier with the lawyer. So, see, it's actually a three-party contract, wherein you have an obligee, you have a guarantor, and then you have the contract owner. Right? It's an assurance, and in India, primarily today, is we just extend, even as a surety bond, what we have in India today is we just extend a guarantee, saying that if there is a loss, I will pay you up to a certain amount of money. But what I believe is in times to come, in the future, we should actually look at it as a performance guarantee, saying that, look, if you don't deliver, your guarantor is supposed to come in and deliver. He's supposed to come in and build this thing rather than just put up that check. Because today the surety insurer can actually get away with just paying that 10% or a 5% performance guarantee. It's not much of a deterrent. So, and so in this contract, so you've got an obligor, which is the contractor. You've got an obligee, which is the contract owner, the project owner. And then you have a surety guarantor, or surety in typical sense of the word is the guarantor, okay? And the bond is the surety instrument that you do. In case of a default, the guarantor would pay up to the project owner, and then he has the right of subrogation, which is granted to him under the Indian Contract Act, to go and collect from the original contractor. To this extent, he can pursue all the legal remedies that are available to him, under the current law of the land, right? As of now, surety insurance, yes, please.
So when you term as default, what I sense is that if L1 defaults, say in the bid project, then the government will definitely not, want to, keep the project in line. So immediately the L2 will be nominated because he was the one who was closest to the bid. Then, sir, where does the participation counts of revoking?
No, so basically, see, there is a damage out there. So what happens is, when there is an L1 and you've been granted that bid, the bid guarantee is supposed to ensure that you accept the bid in the form and manner that you have bid for it, right? So that's how this entire thing operates. So even if there is L2, there is a certain amount of a loss which has been incurred by the National Exchequer.
But sir, what I sense is the L1 is still not paid because he has not completed the project.
No. So bid is bidding for it. Then you get granted the contract. Then that's when the performance guarantee comes in. So the bid guarantee moves away. Once you're granted the contract, then he has to complete the project, right? So that's how the entire structure works. Now, most of the surety structure, how this entire thing works is, surety, by virtue of their entire nature of business that they are, underwrites the contractor in a far more detailed manner than that you would have with a bank. So we've got something which is more famously known as the 3 C's of surety underwriting, which is called character, capability, and capital, right? Which is essentially, it's just not about the capital, or it's just not about kind of money or the kind of experience that you have. It's a more holistic this thing. There was a study which was conducted in 2022 with Ernst & Young, and along with the Department of Transportation, as well as the Surety and Fidelity Association of America. And the study found out that non-bonded contractors, and I'm talking of people who are not backed by a surety bond, have a 85% higher chances of default than a bonded contractor. Now, this is not because of anything else, but this is because of the kind of underwriting that the contractor has been subject to, and by virtue of this underwriting, you get a far more capable contractor who's bidding for the project, right? And you have more capability on the table means better chances of delivery. So that's how this, a surety player brings in more efficiency. And then there are numerous amounts of number of studies that have been conducted. Another one that comes to my mind is a study which was conducted by there's this organization which is monitoring of Canadian Institute of Monitoring Economy. I think that's how it is meant. Maybe I'm getting the name a little wrong. A non-bonded contractor has a 10 times higher probability of default. So there have been numerous studies which have been conducted, which bring out the efficiency and the discipline that the surety bond player actually brings to the overall contracting, the project execution. So that's how it has happened. That's how it works. And it is primarily because of extensive underwriting that the contractor undergoes. I believe, surety insurance in India is still at its nascency. And I believe that this, as it evolves over a period of time, a bonded contractor would always have a higher chance of getting the project, even though he may be backed, even someone else might be backed by a bank guarantee. Most of it I've already covered. It actually works for both the parties, so for the project owner, he gets competent contractors, and this is purely by virtue of the kind of underwriting that he does. Now, what he does, so if you look at when you have a contractor who doesn't have to put up a large amount of bank guarantees, and bank guarantees have a cost because there's a cost of liquidity, there's a cost of paying for the bank guarantee, there's a cost of borrowing because he's had to borrow additional amount of money to execute the project. It also results in higher bidding. So it's also been noticed that bonded contractors always have a lower bid, so you reduce the overall costs also. A very important thing is, see, bank guarantee just compensates for the loss. See, it's not a very proactive thing. Okay, it's a more of a let's say it sits behind somewhere unless you have a loss, and then the bank guarantee is called on for the loss. But a surety player would constantly monitor, keeping on track of the project and try to see if there is a default which is likely to come. So it is more like prevention rather than a cure. So it's just not a compensation kind of a mechanism. It is more about everybody's interested cumulatively in ensuring that the project is delivered on time and within the cost that it has been bid for. So that's blinking. So, that's the advantage that it has for the project owner. I think for the contractor, it is self-explanatory. It's actually a no-brainer. It need not be mentioned because it unlocks his collateral, it unlocks his margin money, he gets more access to credit, there's more money for execution. It also helps him bid for more projects. So it's about, the moment you have a bonding limit with a surety insurer, you will continuously be able to bid for more and more projects. You won't have a situation similar to what the MP Rural Roads Development Authority was experiencing. What happens is, see, there is always this incentivization towards, incentives drive behavior. I think we all understand that, right? So the moment you realize that a contractor is good, the surety bond keeps on supporting him with bonds, he's able to grow further. So overall, it incentivizes a better behavior as well. But yeah. Yes. Yeah. So anyway, I think this is something that everyone here in this room understands better than me, that across the life cycle of the project, bonds are ubiquitous, guarantees are ubiquitous. I mean, this doesn't require any explanation. He's working on an either-or situation. Either it works here or it works there. So, see, surety bonds have been, in extensive use globally. So whether you look at parts of US, Canada, they are of course the largest markets for surety bonds. But it has grown extensively in South America, Europe, of course. You look at Australia, Malaysia, Southeast Asia. It's all a growing market. But Canada and US have been the largest this thing. So in the US, surety bond, you don't put up a bank guarantee. Now, surety bond is mandatory. And you've got this act called the Miller's Act in the US. And each state also have their have their own version of the Miller's Act, which mandates a surety bond for all infrastructure projects. And sometimes, surety bonds are also mandated for projects as small as $25,000 also. So that's the extent of pervasiveness that surety bonds have achieved in the US. A lot of these US markets have entire project covered by a performance guarantee. It is not 10%. So essentially what happens is, if it is a $100,000 project, you cover the entire surety bond with a $100,000 project, and then in case there is a default by the contractor, the surety bond player would have to come in, and either he completes the project himself or he gets another contractor to complete the project within the same terms. Of course, the concessionaire agreement forms the basis for implementation of the entire project. So that's how serious people are, and that's how things have moved in most of these economies where projects have been delivered on time and within the same kind of costs that you have, right? And see, unlike India, because of the nascency, we still don't have reinsurance support in India. But essentially, it's a very well-developed mechanism. It is well-oiled machinery that operates for small contractors as well as large contractors. US also has something called a Small Business Administration, which helps smaller contractors but capable contractors get access to bonding limits, right? I think we've already discussed the benefits, that better contractors, timely project completions, lower losses because the surety himself comes in and tries to implement the projects. And best part is you have enough data for contractor performance. So today, if you look at in the Indian scenario, you have data which is distributed all over the place. So each bank, and none of the banks wants to actually share the data on contractor performance. Most of our contracting awarding bodies also do not share data available on contract performance, other than some of those sites who have got blacklisted contractors. You don't have otherwise, it's not a common pool of contractor performance. But what happens is that once you have sureties as an evolved mechanism, you'd start having contractor performances available also at the click of a button. The way we see it moving, I think big steps, positive steps have already been taken. We've now allowed insurance companies to issue surety bonds, although it comes with a limit on their total portfolio. We've also recognized it as part of GFR. I think what needs to be done is also amend GFR to include, other than just performance guarantees and bid bonds, we've got to look at extending the acceptance to advance payment guarantees, maintenance guarantees, retention guarantees, etc. These have to be included as part of an accepted security under the GFR, right? I personally believe that it should become mandatory in all government projects. I think bank guarantee should just go because of the inefficiency that it brings to the overall system. And each and every department within the country should be informed and told that, look, this is what it is. You might as well start accepting surety bonds instead of bank guarantees. Well, that is it from my end. Because I believe that, with surety bonds, we are going to move from a collateral-based system to a capability-based system, and where capability should become the new collateral, actually. It cannot be that just because, I have the capacity of putting up a few land and property that I should get more contracts. I should have the capability. I should have the necessary engineers, the necessary equipment. I should have the necessary capital to go in and implement. I should not be a guy who's been building roads, let's say on the hills, and then I come back to Mumbai and say that, look, I want to build that Worli Sea Link because I clearly don't have the capability to do that. But I'll get a bank guarantee to do that, right? So I think that's where we should move from. I believe that we are at the beginning of a very exciting journey for this entire sector as a whole. Thank you so much. Happy to answer any questions.
I have a question. No, not a question, actually, more on this surety bonds, See, India is at a really very, very nascent stage as far, like defect liability products are still not available. Neither they are IRDA approved, Two things which are stifling, completely stifling, surety bonds is they're not financially integrated, When you go for a BG, you are financially assessed. I'm not talking about performance because that's a different subject altogether. And I do believe even insurance do not have capability in India to understand because sector analyst, all those things. The capital formation in insurance itself is not sufficient enough, because they are still evolving, It's a 20-year-old sector for us in private as far as, The financial integration which I am speaking is really, divided between IRDA and RBI. The same thing that we saw for listed instruments between RBI and SEBI, that turf will open up, What India probably needs to do is come up with a financial commission rather than RBI, SEBI and IRDA. Second, bankability, even LCs globally are not a preferred product, there's preferred product is surety, But the bankability of surety in India is actually zero. If you give me surety bond and I want to bank it tomorrow, it's not possible unless the futuristic event occurs, Globally, it's not that, Any thought that's going on in government on that front, it's just one circular that use bonds is not enough. Is this happening or not in finance ministry is more important.
Yeah. So I think answering your question whether we should have a finance commission instead of SEBI, RBI and IRDA is beyond my pay grade. So I don't think I can influence that. But we've got to live with whatever is there and try and make the best out of it. But having said that, yes, I completely agree with you because a lot of these developed economies, eventually the market regulator as well as the insurance regulator, they fold into the central bank. It's there in a lot of these geographies. And I guess in future, we'd probably...
Bankability will never happen.
You're absolutely right. So in future, maybe in the next version of Viksit Bharat, we'll probably see something like that. But very difficult for me to really comment on that. That's one. Second thing is, there has to be cooperation between banks and insurance company as far as adoption of surety bonds is concerned. Now, when I was also involved to some extent when the draft guidelines were being drawn up for surety insurance. The draft guidelines as well as the final guidelines has this provision within the paper is insurance companies can collaborate with banks, data exchange, risk sharing, etc. So some part of that mechanism for risk sharing, etc. has been drawn up. There is a thought behind it. Now, how well we as as a country we go and build on that, it actually depends on in a lot of people getting together.
That will happen when there will be a fraud in bank. Now that there have been BG frauds, SFMS and all those things have come up. Insurance, there is no such thing existing.
True.
I can drop a false, insurance bond and just hand it over.
You're right. I hope it doesn't happen because it will sound the death knell of an organized of a business which is just in its.
I'm speaking of this integration, not just sharing. It's an integration that's essential.
I guess you're right. I mean, but this is something that it has to become a movement. I mean, see, it's in its infancy at this point of time. A lot of people have not heard about surety bonds. So, for example, if you go up in rural areas, a lot of these contractors have not heard of surety bonds as yet. So a lot of education. This entire product itself, number one, has to go through that curve, education curve, trying to tell people what it does for both contractors as well as for this thing. Because you go and meet, let's say, even if you're going to meet somebody in Assam, that guy will probably say that, why should I accept a surety bond when I get a bank guarantee which is payable, which is an on-call document, and you're trying to tell me that you want to issue me a conditional document that you have to prove that there is actually a default on paper. See, today all surety bonds today are also on-call documents. These are unconditional guarantees, which is not really a desirable case. But today, let's say a government in Meghalaya or Assam would even, or for that matter, even National Highway Authority, they don't accept conditional guarantees. So it is a journey, and I think we should just allow ourselves that kind of time for the journey. Yes, ma'am.
With regards to, say, bank guarantee when it gets revoked, typically now questions asked, the guarantee amount is released by the bank. How does it happen with the surety bonds? Is it a separate due diligence which post-invocation will call for, and then only a portion of the demand is released, or is it the full amount gets released? How does that get operationalized? If you can throw some light on
So,
that.
ma'am, in fact, that is what we were just talking about. See, bank guarantees are on-call documents.
Yeah.
Right? Today, all the surety bonds that are being issued in India, they are all on-demand guarantees. So I don't have to prove that there has been a default. I just call on the guarantee and I expect to be paid. Now, typically what happens in the current scenario is that if there is a bank guarantee which has been invoked, somebody from the bank will call up the contractor. Contractor then rushes to the nearest court and gets a stay against the bank guarantee. So these are hassles, and this is something that we've seen during my engagement with the various state governments. But a surety bond at this point of time, although it's not a desirable scenario, operates very similar to that. The moment there is a call, the surety insurer has to pay.
Okay.
Ideally, I would, if I may add, I would like to see a situation where there is a conditional guarantees that you just can't call on a bond unfairly, and it's happened. So if I may add, there was this incident in Dubai. So there was this project on an airport which was going on, and the owner, the project owner, he would come on multiple inspections, and he noticed a couple of those workers who would smoke incessantly at the site. He didn't like it, and he just invoked the guarantee. So these are established cases of unfair, invocation of the guarantee, and we've also heard about the Lanco Infratech case where guarantees were invoked unfairly. So, and see, usually the guarantor does not have any other option but to honor that guarantee, even though it may have been on this thing. So the ideal situation is that we should actually look at a situation where guarantees are conditional guarantees. Tell them that there is a default. These are under the clauses of the concessionaire agreement, that there is a default and it has to be paid. So that you bring people on a more equitable footing rather than have somebody who's always subject to the mercy of one particular person. And we've seen that in many cases. Guarantees have been invoked. The guarantee ka case alag se chal raha hai, but satisfactory completion of the project letter has been issued. We've seen so many such kind of cases, and I'm sure there would be more.
And second thing is, when banks lend, say either they have a funded exposure or a non-funded exposure to a contractor, they also have their own monitoring mechanisms, especially towards the project. A lender's engineer is appointed. They also go through project progress and so on and so forth. So, how do you think this will be even superior when it comes to the surety bond guarantor? Because banks typically also have a pulse through an access to a direct current account, or the other debits credits flow of that particular contractor in their book. So they have actually a more nearness to the cash flows of that project. Whereas when it comes to a surety bond, I am not sure if that is possible. So how can they have a better pulse on the project monitoring vis-a-vis a traditional banker?
So this is something as of now, with all the insurance companies who are currently issuing surety bonds, it is not happening. Okay, because most of the people are still grappling to get into terms with what this product is, how should they approach it, what are the control mechanisms that they need to put into place. So as of now, it's not happening, but I'm sure most of the insurers, as and when the portfolio gets larger, the risks start accumulating on their balance sheets. That's when people will come around and say that, look, how do we monitor this project? And I believe that there are numerous tools which are now available. I think we talk about AI. We talk about there is an AI conference which is going on in Delhi right now at this point of time. We talk about a lot of data which is available, through API integrations, this thing. I'm sure there's a lot of this thing that can be put together and proxies can be created to understand how the project is monitoring. So I was speaking with Mr. Jaishankar, the CMD of
IFCL.
IIFCL, yeah. And so we had a very interesting conversation, because he was into financing of infrastructure projects. And we said that, look, we are also going to be having this kind of similar things, concerns. So he started talking about satellite monitoring of projects, how you can monitor what is the kind of, let's say in case of a road project, how many kilometers have been laid, what's the timeline. You keep comparing various pictures. You can have, so I've also met one software company which kind of would,
Images.
yeah, sorry?
Images.
Yes. So what they would do, they would take pictures, they would set up cameras at the sites, and they would take that and they create a completely different mirror online, and they'll tell you exactly what is the kind of material, etc., that would have been consumed. So I think various tools are coming up. But again, I believe that this is a journey, which has to be undertaken. There will be some trial errors. There will be some, blow-ups. But this is something that will grow over time. But a lot of tools are available at this point of time. So I met with one person who said that can we get into the account books of the contractor? Can we integrate with them and see whether we can get access to that data and we continuously keep monitoring? Otherwise, I'm sure they have that lender's engineer who will be there. I've seen how lender's insurance advisor works. I'm not sure if the lender's engineering advisor also works in a similar way, then there's a cause of concern. So, but I mean, yeah, I'm not commenting. Yes, sir.
So, in case of an EPC company which has already raised by way of BG limits of 100 crores, and additionally they want to raise surety bonds of 50 crores. So, along with BG, can it be raised
Yes, sir.
additionally surety bonds?
It's happening. Ho raha hai.
Noted, sir. Thank you.
Mr. Parwal can help you.
Yeah, surely.
I have a question.
Yes, sir.
Surety bonds coupled with collaterals, how they different from bank guarantees?
No, there are no collaterals in surety bonds.
Most of the surety bonds we receive, they are asking collaterals actually.
You're right. So, people, in fact, surety bonds with collateral, they don't take 100% collateral, even what's happening now. It's happening with 10%, 15% collateral. But typically, see, it should not happen, okay? Because the way I look at surety is, when I am going to assess capability of the guy, I have to be very sure about, whether this guy is going to deliver or not. So once I'm sure of this person is going to deliver or not, I extend a bond to him, and then hedge my risk with a reinsurance capacity. That's how it is ideally, and this is how it will move in India also. These are very early days, and see, every time that something has been launched in a country during early days, it has its own way of finding its feet, working on various things. I guess this will happen in India also.
Some surety bonds we've seen, they are asking for personal guarantees from banks. So,
See, indemnity will always be there. Yeah.
But the indemnity also says there are collaterals in the form of personal guarantees or guarantees. So I think that's
Yes.
not the ideal scenario for surety bond to.
So it depends on contractor to contractor. I believe that personal guarantee of the director is not going away very soon. Even though the collateral will go, that fixed deposit part will go, but a personal guarantee of the directors is not going very soon. Yes, sir.
Any defaults as of now?
Yes, there have been defaults, but nothing very major.
But
nothing
which matlab, how we come to know which are the defaulted company? Because we should be aware who are the defaults if we go in front of any person, at least.
See, this is something that the industry suffers from at this point of time. We don't have any consolidated data of contractors who have defaulted, people who have been claimed against. So as such, that data is not available. So
It doesn't reflect in CIBIL also?
CIBIL does not take reports on defaulted data for contracts.
Okay.
I guess my time is up. So, thank you so much. It was really a pleasure. Yes.
I am very happy that our Sandeep Parwal and his team has organized See, as I earlier also mentioned, those who are interested, they will be here. And those who are not able to come, we have to reach out. So the full recording has been done. So this, whatever you have made a session, no, that will be broadcasted and it will be on the website of Sandeep Purwal company and all. So it will be very useful. Even the current, our speaker talked very important on bond and other things, I think. So give a big clap to Sandeep Purwal and his team, SP Associates. Huh? So, sir, you would like to say a few words, sir? Please. Briefly, I'm here.
You give me an opportunity and I don't
No,
miss
we
an
are
opportunity.
partners
Thank
always
you.
now. Yeah.
Thank you very much, and thank you everyone. And because it was really insightful and meaningful, I believe the industry is interested in knowing more and getting deeper in the industry. Thank you everyone. So just some awards and just recognition.
Award दीजिए ना?
हाँ, देना है sir.
हाँ?
देना है.
हाँ, करिए.
आपका देना.
Huh?
I'll just call all the speakers one by one.
Yeah,
and
please
maybe
give a call.
together if all of you could come over,
Please
that would
come
be really
up, yeah.
wonderful. Dilip ji, please ek baar aap aiye.
Aye.
Manoj ji and Manoj ji, ma'am, please.
आप भी आइए.
And Vikas.
Yes, come. I'm there.
Everyone, Mr. Kamal Somani is here.
ये bond market का पितामह.
So he is the guide and the guardian of the industry and everything. So please.
Please. No, I am not. अरे, नहीं, आप दीजिए. I am there. Yeah. Thank you so much. नहीं, जरूरत नहीं, वही somebody says. Yes, sir. Photo important. Record.
Thank you so much.
ग्रुप पिक्चर. एक ग्रुप फोटो निकाल दीजिए. आइए. थोड़ा आगे.
Thank you very much.